Okay, Havells numbers, and they're going to be an important set to actually address because it seems like the second quarter performance is a little bit weak and it's not quite matching up with what the street at least was anticipating. I'm just going to quickly bring up that stock as well for you and show you how it's currently been panning out. Because if I just look at how the comparables have actually shaped up for Havells, it seems like a bit of a weak set. The financials clearly seem like they were impacted by Lloyd's this time around. The revenue has come in just very flattish at about a 2% growth of 20 to 30 odd crore rupees. The net profit is pretty flat at 1%. EBITDA actually has fallen by about 11%, and the margins have also dipped at about 10.4%. Largely, the range that the street was working with was roughly about 11.8, 12 odd percent on the higher level. 12%, remember, was the comparable in the same quarter last year. So in that sense, Havells, you'd have to say, has somewhat disappointed the street. Avan?
Oh, yes, indeed it has. You know, we weren't going in with very high expectations, but nonetheless, despite that, it's been a bit of an underperformance. Remember, the lower operating leverage as well is what has eaten into the operational performance or the margin picture. So that's come in significantly lower. The EBITDA stands at about 235 crores with a margin at just about 10.5%. And, it would be interesting. I'll just be pulling up as well the individual growth performance, what they've seen in the ECD segment, whether or not we've seen the cable and the switchgear segment as well grow. But after flattening out, the stock has just about managed to recover at 673. In fact, let's just get in a quick chart check as well. And Kunal, come in on Havells.
Yeah, I think the stock is consolidating, at 670, 675 levels. Over the last, I think, 2 weeks as well, there was 2 attempts towards 700 mark, but the stock failed to breach that 700 mark, and it was, coming back to, strong support levels as well. So I think net-net the stock is still in a range, but the long-term patterns have been quite bullish for the stock. So I think this fall doesn't get more aggravated and the stock doesn't break the 650 mark. There could be chance that you might see the stock consolidating for some time, and then the pickup could happen on the upside yet again. So I think Havells could be more of a buy on dips, and especially if the stock comes back to those key support levels of 650.
Okay, 679 right now, although, that break as well in the stock has been very, very shallow. It's got immediately covered into. Let's take it across to Sanjeev Zarbade. Sanjeev, I don't know how closely you track Havells, but the numbers look a little flattish this time around. It seems like Lloyd's has impacted the performance in the quarter gone by. But would you say if there is a significant dip, it's to be bought when it comes to names like Havells?
Yes, thanks for having me on the show. Regarding Havells, we were expecting kind of weak numbers because the consumption trends have been quite tepid last 3 to 4 months. If you look at the wires and cable segment, so the main demand driver for this segment is the housing. And we are seeing quite weak growth in the housing segment as well. And later on, we have seen that the fans as well as the kitchen appliances have not really grown at the pace that Havells has seen before. To that extent, there has been limited expectations regarding strong growth. So far as our outlook on the stock is concerned, we find that the valuations are quite expensive at this point of time, and we have a sell rating. But Havells is a one stock which is kind of a market leader in its segment, and it kinds of prices its products at a premium as compared to other brands, and hence its return ratios, margins have consistently remained superior. So while we like the management, we like the business, we like the company, but because the valuations are a bit expensive, we would like to get into the stock at a lower level.
Okay, that's Havells for you. Now let's talk about some other names also in action this afternoon. We were looking at earnings, Sanjeev. Let's just talk about HCL Tech for a moment. How you feel that IT major particularly is poised, particularly after we've seen TCS disappoint, now Infosys embroiled in the whole corporate governance tangle.
In HCL Tech, we are expecting revenue growth of 9% on a year-on-year basis, and profit after tax of 13% on a year-on-year basis. Also, the things that we need to watch out for would be the demand trends, because there are signs that the US geography is slowing down, and also we would be watching out for the EBIT margins, because costs have gone up in recent times. So these are the two things that